What's up? So today we'll be talking about holding emergency funds and interest earning stablecoins. Is it a good idea or a bad idea? Some of the topics we'll cover is what is an emergency fund? What are stablecoins? What are some popular platforms that offer stablecoin interest? What are the pros of holding an emergency fund in stablecoins and what are the cons? At the end I'll give my own opinion and I'll tell you what I'm doing with my own money. If at any point you decide you like this video and find it helpful, don't forget to hit the like button because that's what it's there for. Also, feel free to lurk below and check out the links in the description. You can get free stocks, free crypto, and other fun stuff. And signing up with these links is a great way to support the channel and say thank you. So without further ado, let's get started. Interest rates are currently at historic lows. The amount of interest that banks are currently paying is absolutely pathetic. The best you can currently do at the time of this video with a so-called high-yield savings account is about 0.5%. Markets by Goldman Sachs, Ally Bank, and Redneck Bank are typically competitive, but at the worst, banks will only pay you an insulting 0.01% interest. That's a measly $1 annually on $10,000 in savings. So Ally Bank is out here roasting Bank of America, Chase, and Wells Fargo. When you go on their website, these boomers have the audacity to ask us to open up a PDF just to see their terrible interest rates of 0.01%. But wait, if you put in more than $2,500, you can get a whopping 0.01%, the same rate. And this is coming at a time when we are hitting the highest inflation rates that we have seen in 30 years. The Consumer Price Index just came out with a 6.2% year-over-year inflation number. So any money that you have sitting in cash is losing its purchasing power by that much. So when you see some of these crypto exchanges paying 7 to 12% interest and sometimes even more for holding stablecoins, and you have that emergency fund doing nothing, getting eaten up by inflation, it's tempting, isn't it? Before we get into that, let's talk about what an emergency fund is. An emergency fund is a fund that you keep for emergencies. Essentially a safety net for unplanned expenses. We're talking about job loss, medical emergency, unexpected home repair, home appliance replacement, car trouble, legal expenses, unexpected travel, etc. Or maybe your emergency is that you aped all your rent money on the squid token and you lost everything.
Dollars. And now the mark, oh! Oh! It went to zero! Yo!
It is estimated that 40% of Americans are unable to afford an unexpected $400 expense. Keeping an emergency fund not only gives you the peace of mind, but it makes you less likely to fall into the black hole that is credit card debt. I'm not sure who needs to hear this, but pay off your credit card balance immediately. Credit card interest can be as high as 40%, and that will absolutely wreck your financial life. We want to be on the right side of compound interest. So conventional wisdom tells us to have a 3 to 6 months emergency fund, depending on your circumstances and your individual risk tolerances. Are you the sole breadwinner, or do you have a working spouse? Do you have kids depending on you? Do you have job security? Stuff like that. Emergency funds should be kept somewhere safe, secure, liquid, and accessible, but not too accessible that you be tempted to spend it on a non-emergency. Next thing you know, you're using your emergency fund to impulse buy a JPEG of an ape for $2.7 million. So it should be separate from your usual funds, and it should be kept somewhere that is as close to zero risk as possible. Some people prefer to hold cash under the mattress, but most people will keep an emergency fund in the high-yield savings account. Of course, there's an opportunity cost to holding cash when you could be investing it for a higher return. People with a high risk tolerances, they might keep their emergency fund in stocks, but of course there's always that risk that when you know what hits the fan, the market will be down and you will be selling at a loss to cover an emergency. Or you might not even have enough because of the losses. Case in point, March of 2020, right about the time when everybody was losing their jobs because of lockdowns. The market was in the dumps. But again, optimizing returns is not the point of an emergency fund. It's for that rainy day where you need it. So let's talk about stablecoins, because we can't own or invest in anything that we don't understand, or at least understand to some extent, because crypto can get a bit complicated. A stablecoin is a type of cryptocurrency that attempts to offer price stability and is backed by a reserve asset. So their price may be pegged to the US dollar or other fiat currencies, to gold or other commodities, or even to other cryptocurrencies. Stablecoins aim to offer the best of both worlds, the instant processing, security, and payment privacy of cryptocurrencies, but also the stability of fiat currencies. They achieve this price stability through algorithmic mechanisms of buying and selling the reference asset or its derivatives. Stablecoins are often used by investors to have stability when moving in and out of other cryptocurrencies without having to convert to fiat currency. And of course, there are platforms that will pay you some juicy interest to hold the stablecoins. Some examples of stablecoins are USD Coin, USDC, Binance USD, BUSD, DAI, Terra USD, UST, and Gemini Dollar, GUSD. So on to our next topic, the crypto lending platforms. How do they work? Who are they? And how much are they paying in stablecoin interest? A crypto lending platform is an online platform that allows you to lend your crypto in exchange of interest. First, a borrower requests a loan from the platform. The duration and amount is defined. The lending platform evaluates the loan. Is it high risk, low risk, etc. If approved, the borrower stakes a certain amount of his crypto as collateral for the loan. Typically, these platforms request 50% of the total loan amount to be available as crypto collateral. The assets of lenders deposited on the wallets of these lending platforms are used to fill the loan. And so investors receive interest, usually weekly or monthly, based on the amount of assets. When the borrower pays back the loan, they can unblock the crypto collateral. Some of these lending platforms are paying 7 to 12% interest on stablecoins. You might ask, how is this even possible? It seems too good to be true. How is the yield this high when banks can't even pay 0.5%? The main reason is that the crypto ecosystem does not have access to the traditional financing options that more established sectors have. None of these traditional firms will lend to you with Bitcoin or Ethereum as collateral. So this lack of access to debt and credit from traditional banks creates the opportunity for these crypto lending firms to do lending at higher rates because there is a demand for it. Take, for example, someone who bought Bitcoin early and was sitting on some huge gains. They need money for something, but they don't want to sell and pay a boatload of taxes. Plus, they believe Bitcoin is going significantly higher. So it makes sense for them to go to one of these lending platforms and borrow against their Bitcoin as opposed to selling it. Additionally, many institutions also borrow Bitcoin to finance market-making activities and sometimes to short Bitcoin. Of course, you have to borrow in order to short. So let's talk a bit about the lending platforms. The point of this video is not to do a detailed breakdown of the pros and cons of each platform. That would have to be a video in and of itself. But some factors to consider when picking a lending platform, of course the interest rates, but also the platform risks, the fees, the deposit limits, the lending duration. Some of the more popular platforms are BlockFi, Celsius, Coinbase, Gemini, Crypto.com, Binance, etc. I would try to stick with the more reputable platforms as opposed to just chasing the highest yield. Also, a lot of people that do this choose to hold coins on a few different platforms to spread out the risk, just a way of not holding all your eggs in one basket. Alright, let's cover the pros of holding emergency fund and interest earning stablecoins. This section will be very quick because it's pretty obvious. Juicy interest rates. That is it. You could earn 0.5% at best in a high yield savings account, or you could earn 7 to 12% interest on stablecoins. I mean, the S&P 500 averages about 10% annually. 7 to 12% is a lot of yield. Keep in mind that these rates do change a lot, so please avoid smashing the dislike button if the rates are lower when you watch this video. Okay, let's move on to the cons, and I'll start off by piggybacking off my last point about interest rates changing. As more players move into the space and crypto lending becomes more mainstream and regulated, we expect these interest rates to come down over time, so the yields may never be as good as they are right now, but they could certainly stay good for a while. But the number one con is risk. An emergency fund should be kept in something that is as close to zero risk as possible. While we can say that these platforms are probably pretty low risk, they certainly aren't zero risk. 7 to 12% interest simply does not come without some risk. That is just not how the world works. And these exchanges certainly aren't as low risk as a high yield savings account. Stablecoins are still relatively new and crypto lending is still relatively new. None of these platforms are FDIC insured or SPIC insured. Also, there aren't nearly as many regulations as a traditional bank would have. Another thing to consider is how fast you can withdraw, convert your money back to fiat, and get it in your bank account to cover an emergency. This depends on the platform and the type of emergency. Can it go on a credit card in the meantime? Will this process be fast enough to cover the emergency? Again, liquidity is very important for an emergency fund. There's also counterparty risk and risk of default. Again, your crypto is not sitting safely in cold storage. It is being lent out. There's always a risk that these loans will not be paid back. This risk can be magnified by extreme market conditions and could lead to significant losses for the companies, potentially causing them to go under, and ultimately, it is your money on the hook. And like they say, not your keys, not your crypto. There's also cyber risk and the risk of hacking. This can either be account hack or platform hack. You can minimize the risk of an account hack by creating different non-public email addresses for your account, creating strong and unique passwords, enabling two-factor authentication, and whitelisting addresses. Two-factor authentication should be done through apps such as Google Authenticator as opposed to SMS. People can SIM swap you. Essentially, they pretend to be you, get the cell carrier to give them a new card. With that, they can get the code for the SMS two-factor authentication and get into your account. As far as the platform hacked, this one is out of your control. Platforms have been hacked in the past, leading to significant losses. It's important to pick only the companies that you deem to have the best security measures, and if they have some form of insurance, that certainly makes things better. But in the case of extreme loss of funds, insurance probably won't be enough. Some investors hold coins across several platforms to spread out the risk. This way they don't have all their eggs in one basket should one go under. While this technically increases your risk of experiencing some loss, it minimizes your risk of experiencing a total loss. There is also a risk with the stablecoins themselves. The primary risk is those that aren't backed fully by the reserve currencies. Any less than 100% backing and risk is introduced. A bank run can potentially cause them to lose value. Additionally, we tend to think about cryptocurrency in tandem with decentralization, but not all stablecoins are decentralized, so they require trust in the organizations behind the stablecoins. An exception to this would be crypto-collateralized stablecoins like DAI, but those that are fiat-backed require trust in the organization. So in this segment, I want to be clear, not all stablecoins are created equally, and therefore the risk of each are not equal. So I can't sit here and paint them all with a broad brush. Some, like USDC, are frequently audited and regulated, and therefore they are much more transparent. Then there are others like Tether that we should be a little bit more cautious about. Tether released a pie chart showing they only hold 76% in cash and cash equivalents, but in reality only a few percent of that is actually held in cash. So going through all the stablecoins would be a whole video in and of itself, but I will say some investors will hold a few different stablecoins in the same way that they use separate platforms, just to spread out the risk, so to speak. Just make sure you are doing research on each stablecoin first. Like they say, trust but verify. Additionally, sometimes the biggest risk is the unknown risk. Like I mentioned earlier, stablecoins in the crypto industry, really in general, is still relatively new and fast growing. The biggest risk may be something that we haven't even thought of yet. I understand that it's very unpopular for me to sit here and spit out fear, uncertainty, and doubt, but sometimes we have to take a step back, look at our investing thesis, and really throw darts at it. Only then can we decide if these risks are overblown or worth thinking about. And also, have we done everything we can to minimize unnecessary risks that we can control? Okay, but what are my thoughts? Is it a good idea to hold an emergency fund and interest-earning stablecoins? Well, the answer is no, but hear me out. That doesn't necessarily mean that I'm not doing it anyway. But let's be honest, the correct answer to this question is that an emergency fund should be kept somewhere as safe as possible and close to zero risk as possible, period. This money is a safety net and is not intended to be used for accumulating wealth. But at the end of the day, everybody does have their own individual risk tolerances. I'm young, I don't have anyone depending on me. I tend to have a pretty high risk tolerance and a relatively aggressive approach towards investing and growing my wealth. Again, because I'm young, I have plenty of time to recover from market volatility, downturns, and mishaps. The opportunity cost of money is so high at a young age that I find it very difficult to have 3 to 6 months of money sitting in a savings account, not earning any interest, getting eaten up by inflation, and not compounding in the market, to the point where I would find myself just not keeping any more money in cash than I need to at any given time. In the case of a financial emergency, I would have to liquidate stocks, so I would be taking a risk that I would have to sell when the market is down. So that would be bad luck. It would be a bummer, but it wouldn't be the end of the world. I have enough money in stocks that I could cover 6 months of expenses, even if my portfolio were to be cut in half. Again, the issue here is the speed at which money can come back to the bank account. I decided that holding 3 to 6 months of expenses in interest-earning stablecoins was a good way to compromise between holding an emergency fund in a savings account versus effectively not even having an emergency fund. So in a way, it is better than nothing. Specifically, I'm holding a mix of USDC, GUSD, and DAI across BlockFi, Celsius, and Gemini. If you're interested in signing up with any of these platforms, consider doing so with the links in the description. This way we can both get $10 of Bitcoin with Gemini or BlockFi, or $50 of Bitcoin with Celsius. They also pay yield for holding other cryptocurrencies too, such as Bitcoin and Ethereum. But back to the topic. I understand that this spits in the face of conventional wisdom, but it's my decision, I own it, and I'm not going around recommending that other people should do the same. But I hope this video was at least food for thought. I hope that you learned something, and I hope that this video at least started the discussion into the pros and cons of this strategy. And again, there is no one-size-fits-all strategy. I know some people will dip their feet into this idea by doing maybe 50% of their emergency fund in a high-yield savings account, and the other 50% in interest-earning stablecoins. But let me know what you think in the comments and what you were doing. But if you found any of this helpful, consider hitting the like button and subscribe for more content like this. Also, consider checking out the links down below. Currently, down there you can get 2 free stocks with Webull, potentially valued up to $2,300, $30 with M1 Finance, a free stock with Robinhood, potentially valued up to $225, and also the promos on Celsius, BlockFi, and Gemini that I had mentioned before. However, again, these promos do change over time. As always, none of this is financial advice, just entertainment purposes only. So thanks, and I'll see you in the next video.